virtuous cycle is you go out and do research, we hope is spurred by the discussions you have with us that make our policy better, and we learn from you, which of course makes our policy better. And that dialogue is something that we want to continue to support, and that's why you're all here at this conference. Now, I know we'll continue that really heralded tradition today. If you look at the program, you see that we're going to talk about, the iPad, I really don't like the iPad, but we're going to talk about price inequality, deficits and inflation, interest rate risk, monetary policy shocks, and inflation uncertainty. And of course, we'll do what we have always done, at least as long as I can remember. We're going to start with remarks from a policymaker. Now, before I introduce our distinguished speaker, I would like to recognize the economists at the San Francisco Fed who put this program together and continue this tradition that I am personally so proud of. We have Andrew Forrester, Huyu Lee, and Fernanda Necchio. You'll see each of them today in the receptions, but also as a role in moderating and managing our discussions. So without further ado, I'd like to say it is my distinct privilege and our collective honor to have my colleague and friend, but most importantly, and I'll underscore this, the Vice Chair of the Federal Reserve, Philip Jefferson. Now, Vice Chair Jefferson, for those of you who haven't read his lengthy bio, has had a distinguished career in public service and academia. He joined the Board of Governors in May of 2022, and he took office as Vice Chair in September of 2023. Just before that, Vice Chair Jefferson was Vice President for Academic Affairs and Dean of Faculty, as well as the Paul B. Freeland Professor of Economics at Davidson College, where I know personally that he navigated through the very challenging time of the pandemic. And from all the colleagues and alumni that I know who went to Davidson, he did it exceptionally well. Now, he's also served in roles as chair of the Department of Economics at Swarthmore College, as an economist at the Board of Governors. I can't say I'm not just a little happy about that. But Vice Chair Jefferson has had a broader role than just in his service as an academic. He's also contributed and been the president of the National Economic Association, as well as service on the Vassar College Board of Trustees and the Board of Advisors at the Opportunity and Inclusive Growth Center at the Minneapolis Fed. He holds a BA in economics from Vassar College, an MA and a PhD in economics from the University of Virginia. Now, here's my favorite part about introducing our guests and our speakers is to tell you a little bit about my personal experience. So on a personal note, I have had the distinct privilege of working with Vice Chair Jefferson on a variety of Fed-related activities and projects, as well as seeing him in action firsthand at the FOMC. In all of these situations, he brings evidence-based thinking, strong reasoning, and a calm mind. And those things are a powerful combination in all that we do. He is also consistently gracious and kind, attributes that distinguish and stand out in what can be heated debates about policy and practice. Vice Chair Jefferson's intellect and disposition have strengthened the Fed and furthered its longstanding practice of doing its best for the American people. So without further ado, I will again ask Vice Chair Jefferson to please come to the stage. Thank you.
Great. Thank you so much.
Thank you. Appreciate it.
Mm-hmm. Good morning, everyone, and thank you, President Daley, for that kind introduction and for the opportunity to talk to this group. I've paid close attention to the papers presented at this annual conference in the past, and I look forward to today's presentations and discussions. Today, I will talk about central bank communications and the use of textual analysis tools. These tools help process qualitative information that may be hard to capture in numerical forecasts. Also, they can improve our understanding of economic concepts that are otherwise difficult to measure. This topic has been covered at this conference in the past, Last year, for example, there was a paper on the program that highlighted the importance of considering the impact that speeches by the chair of the Federal Reserve have on asset prices when evaluating the transmission mechanism of monetary policy and the rest of the economy. This paper also shows that speeches by the vice chair are less important than those by the chair. Okay? So this might be a good time to catch up on your text messages, but just kidding, don't do that. My talk is organized as follows. First, I will briefly discuss central bank communication and its effect on asset prices. Next, I will discuss how recent advances in automated textual analysis may be having an impact on how the information in central bank communications is incorporated into asset prices. Then I will review how researchers and market participants use textual analysis techniques, among other techniques, to gauge who is listening to central bank communication and to understand how monetary policy is transmitted to the economy. Before concluding, I will broaden my coverage and discuss how textual analysis tools can be used to estimate difficult to measure concepts in economics, such as uncertainty and supply chain disruptions. These new textual analysis techniques are important to me as a policymaker because I want to understand how our communications are being heard, interpreted, understood, and acted upon. Former Fed Chair Ben Bernanke often highlighted the importance of central bank communications, saying that monetary policy is 98% talk and 2% action. Obviously, the 98% is hyperbole. It's not meant to be taken as an exact measure of how much of the monetary policy transmission mechanism is due to central bank communications. Even so, research and my own experience confirm that central bank communication is key for the transmission of monetary policy. In remarks I delivered almost 2 years ago, I discussed how monetary policy is transmitted to the rest of the economy through financial market prices. Changes in the federal funds target range are transmitted to overnight money market rates and other short-term interest rates through arbitrage relationships. The configuration of short-term interest rates, central bank communication about the likely path of future short-term interest rates, and the associated economic outlook, in turn, affect long-term interest rates through investors' expectations. Higher long-term interest rates increase the cost of borrowing for households and businesses, thereby affecting households and businesses' spending, saving, and investment decisions. Policymakers' approach to communication has evolved over time. In the past, policymakers were not focused on clarity and transparency in their communication as they are today. For example, former Fed Chair Alan Greenspan famously quipped in 1987, and I'm quoting, if I seem unduly clear to you, you must have misunderstood what I said, end quote. In the 1990s, however, he started to embrace transparency. Figure 1 shows a timeline of the steps taken towards increasing transparency at the Fed since the 1990s. In 1993, the Fed started to publish Federal Open Market Committee meeting minutes in their current form. And soon after, it began releasing FOMC meeting transcripts with a 5-year lag. In February 1994, the FOMC started to issue post-FOMC meeting statements following meetings at which there was a change in the intended policy stance. Later, it regularly incorporated the target federal funds rate into these statements. In May 1999, the FOMC started to publish statements after every meeting, even on occasions where there was no change in policy. In 2004, the FOMC accelerated the release of the minutes to 3 weeks after the meeting as opposed to after the subsequent FOMC meeting. During the tenure of former Fed Chair Ben Bernanke, the Fed's transparency increased significantly. In November 2007, the FOMC began releasing the Summary of Economic Projections. In 2011, Chair Bernanke started holding press conferences after every other FOMC meeting. In 2012, under his leadership, the FOMC adopted an explicit inflation target of 2% in its new statement of longer-run goals and monetary policy strategy. Also, it started publishing anonymized individual FOMC participants' views on the appropriate future path of the federal funds rate, now famously known as the dot plot. In 2019, Chair Powell continued this march towards transparency and started holding press conferences after every FOMC meeting. Of course, Chair Powell and other policymakers testify regularly before Congress as required by law. Also, FOMC participants give public speeches and transparently discuss their views on monetary policy and associated issues, as evidenced by my speech here today. Previously, I have spoken about two primary reasons for the increase in transparency. First, transparency allows for greater accountability to the public. Second, there's a growing appreciation in the economics profession that clarity about policy actions helps the transmission of monetary policy to the rest of the economy by, for example, making asset prices more informationally efficient. Relatedly, by conveying aspects of the Fed's reaction function, communications can help inform investors' views about the likely future path of monetary policy in a way that helps achieve the Fed's monetary policy objectives. Central bank communication is clearly important for shaping the path of interest rates, so it is not surprising that investors and researchers use textual analysis techniques, including artificial intelligence, to quantify in an automated way information conveyed through FOMC statements and other communications, such as speeches by governors and Fed bank presidents. Researchers have tested the hypothesis that clarity about policy actions would help the transmission of monetary policy to the rest of the economy. Using textual analysis, high-frequency asset price data, and high-frequency central bank communications, this research shows that investors' reaction to specific sentences communicated by the central bank are quickly incorporated into asset prices. In addition, economists have used textual analysis to understand how media reporting of central bank communication affects short-term interest rates. For example, some have used a bag of words technique to estimate media sentiment during FOMC announcement days. By design, a high media sentiment is meant to capture times when journalists report that the FOMC is more likely to tighten monetary policy in the future. Figure 2 shows that the correlation between media sentiment and 6-month U.S. Treasury yield changes is positive and relatively high, which suggests that media reporting in central bank communications plays an important role in the transmission of monetary policy. Policymakers know that their communications are likely to affect the course of short-term interest rates, other asset prices, and the associated economic outlook, resulting in an easing or tightening of financial conditions. Therefore, policymakers have always paid close attention to what they say, well before market participants started applying artificial intelligence tools to central bank communications. In general, researchers argue that automated textual analysis and automated trading have increased the speed with which information is incorporated into asset prices. That suggests that asset prices have become more informationally efficient, sometimes in a matter of seconds or even milliseconds, instead of minutes after information is released. Thus, increased transparency and advances in technology have potentially made asset prices more informationally efficient, which in turn helps the transmission of monetary policy. Yet others argue that automated algorithms may be more prone to mistakes than humans, may provide an incentive for investors to value speed over accuracy, and may reduce the long-run informativeness of asset prices, which could hurt the transmission of monetary policy. I look forward to findings of future research as we develop a deeper understanding of this issue. For now, I do not think artificial intelligence is changing the way policymakers communicate, but research shows that it has affected how quickly information about policy is incorporated into asset prices. Next, I will discuss whether research using textual analysis is helping policymakers to understand better who is listening to central bank communications. In 2018, former Vice Chair Alan Blinder predicted that, quote, central banks will keep trying to communicate with the public as they should, but for the most part, they will fail, end quote. He explained further that, quote, many economic models presume central bank communications is aimed at wage setters, price setters, consumers, or investors, maybe all of them, but are they listening, end quote. His answer was no. They are not listening to central bank communications, and he cited economic research using survey data to support his answer. More recently, however, research shows that non-experts and households are listening to central bank communications. Some of this research uses textual analysis, and some uses randomized controlled trials. Researchers have used textual analysis to process automatically and quantify more than 3.2 million posts on social media by experts and non-experts. This research shows that journalists and professional forecasters who comment often on central bank policies, as well as non-experts who do not comment regularly on central bank policies, do listen to central bank communications. Further, research shows that direct central bank communication and the media's reporting of central bank communications are highly correlated. Yet, when they do not align, the media's reporting tends to have a larger effect on asset prices and professional forecasters' views about the future than central banks' direct communication. In addition, a randomized controlled trial with nearly 20,000 U.S. individuals shows that central bank communication affects households' inflation expectations, which in turn affects their behavior as measured by scanner-collected data. This research shows that while central bank communication tends to affect households' expectations and spending behavior, the way in which households receive the information matters. In particular, households appear to react more to information conveyed by social media, family, and friends than to information conveyed by traditional media. All told, this research suggests that central banks' efforts to communicate with the general public are having some success, but there's still room for improvement. Textual analysis is not only helping researchers understand who is listening to central bank communication, Generally, it is helping them to measure qualitative information that is hard to capture with numerical forecasts and estimate difficult to measure concepts, economic concepts such as uncertainty, supply chain disruptions, and financial conditions. As I mentioned in a previous speech, uncertainty is not directly observable in the same way that inflation and economic output are. Notwithstanding the difficulty in measuring uncertainty, researchers have developed ways and tools to assess it. In fact, in the past 2 decades, there's been tremendous growth in research devoted to the subject, especially on text-based measures of uncertainty. For example, researchers created an economic policy uncertainty index, shown in Figure 3, based on the number of leading newspaper articles that contain a combination of words related to economic policy uncertainty. As shown in the figure, economic uncertainty in the US reached an all-time high at the onset of the pandemic, came down slightly after the pandemic, and has recently increased as the potential economic implications of new government policies are discussed in newspaper articles. Research also shows that newspaper text-based measures are highly correlated with stock price volatility, and that higher values of these measures are associated with lower investment and employment. A corollary to that insight is that policymakers should communicate clearly as possible to avoid increasing uncertainty. Recent research has also discovered that narrative sentiment conveys information that may be hard to capture in numerical forecasts. For example, it was shown that the tone of text accompanying a set of economic forecasts produced by the Fed's staff predicts forecast errors of the Fed's staff as well as blue chip participants. The predictive power of sentiment seems to be arising from signaling the downside risk to economic performance for output, employment, and stock returns. These findings suggest that the tone of the narrative captures information that is not necessarily provided in corresponding forecasts. Not surprisingly, given this information, the tonality has predictive power for stock prices as well as monetary policy surprises. Another example of how textual analysis is helping researchers estimate difficult to measure concepts is new measures of firms' demand and supply shocks. Traditionally, academic researchers use sign restrictions in price and quantity measures to identify and differentiate demand shocks from supply shocks. An increase in price and quantity is considered a demand shock. An increase in price accompanied by a decline in quantity is considered a supply shock. These so-called sign restrictions are useful tools. However, it is possible that an increase in price and quantity can be due to a surge in demand in the face of supply chain disruptions. Other popular measures of supply chain disruptions are supplier delivery times and order backlogs provided by the Institute of Supply Management. These measures, however, only estimate firms' activity relative to the previous month and can lack important context for understanding short-term dynamics that can otherwise be captured in qualitative text-based measures. Thus, it can be useful to complement sign restriction methods, supplier delivery times, and other backlogs and order backlogs with textual analysis techniques that quantify firms' narratives in earnings calls in the Beige Book to identify better demand and supply shocks. For example, Figure 4 shows the supply chain bottleneck sentiment index, the solid black line, estimated by a board economist using textual analysis techniques to quantify the information conveyed in the Fed's Beige Book publications, along with the ISM Supplier Delivery Index, the dashed red line. For illustration purposes, both indices are normalized to have a zero mean and a standard deviation equal to 1, with large positive numbers indicating that supply chains are stressed. Both indices surged in the 1970s after the oil price increase and ensuing energy crisis. Supply chain disruptions reappeared in the 2000s with chip shortages. And most recently, bottlenecks arose during the COVID-19 pandemic. The figure illustrates how the text-based measures signal a more prolonged period of supply chain disruption during the pandemic. Comparing both measures, we see that the monthly change in delivery times improved at a fast pace, as shown by the ISM index. But narratives of the post-pandemic recovery, as captured in the Beige Book, were signaling elevated levels of supply chain disruptions that eased more slowly. The idea of using qualitative information on media, government records, central bank, or management communication in economic research to understand better the transmission of monetary policy is not new. What is novel is that in the past 2 decades, there have been advances in textual analysis techniques and incredible growth of data that are easily available to researchers and investors in terms of both volume and variety. The advances in textual analysis techniques and the growth in alternative data have, in turn, helped researchers to better estimate difficult to measure economic concepts, to more easily identify who listens to central bank communications, and to investigate how quickly central bank communications is incorporated into asset prices, among other things. Also, we have greater access to high-frequency data, such as millisecond time-stamp financial transactions, and alternative data, which includes textual information from social media posts. As I mentioned earlier, these new textual analysis techniques are important to policymakers because we seek to understand how our communications are being heard, interpreted, understood, and acted upon. While I am grateful that textual analysis techniques and data access have improved over the years, I will end on a cautionary note. Automatic textual analysis should not be regarded as superseding other analyses of the historical record on monetary policy. A wealth of data and techniques to analyze text does not necessarily translate into greater insight. Therefore, it is important that policymakers, researchers, and investors continue to be diligent in using the right tools and the right data to make the best possible inferences. Thank you.